People always ask why I wear the hat with these button-up shirts when I'm not bald, at least not yet. And it's because it's America. And shout out to the vets and the public servants that make this possible, allow you to do what you do every day. So quick shout out to you guys. But in this video, we need to talk. There's quite a few things we're going to get into. Some news for Tesla, including Tesla actually just cut the price of the Model 3 inventory. And this is interesting. So I want to talk about that specifically, as well as the CPI report coming out tomorrow. Because if there's a catalyst that could crash the markets here soon, CPI is one of them. So we have the estimates from your large banks, and I have my own estimates, as well as kind of if this happens, this will happen in the markets. If it comes out super high, what happens to the markets? If it comes out super low, what happens to the markets? And what could ultimately happen with Tesla stock? We also have some analyst commentary. Someone finally said it and spoke about the auto delinquency rate, showing there's problems in the economy. I've been waiting for this, and it finally just happened. So I want to share that clip with you, as well as another clip from an analyst with Needham that says Tesla could continue to cut prices. So I have all of that for you and much more. Hit the like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. What do you think is going to happen to our markets coming tomorrow? So the first thing I want to share with you is the fact that Tesla has reduced Model 3 inventory prices in the US. It looks like Tesla is dropping prices on inventory for the Model 3 units in the US ahead of plans to launch a refreshed version of the electric sedan. Although Tesla has already begun selling the Model 3 refresh in a number of markets, the automaker now seems to be lowering inventory prices in the US, likely to prepare for a North American release. Prices on inventory for the Model 3 have been dropped in markets across the US, as can be seen on the automaker's website. At the time of writing this piece, inventory versions of the current generation of rear-wheel drive Model 3 units can be found for as low as $36,220 before incentives. So that $29,000 Model 3 is becoming a little more regular occurrence across the US, at least for the inventory. If you get custom designs, obviously it can run a little bit higher than that, but you're right at about $30,000 across the board for inventory. The last little paragraph of this article says prices for the refreshed Model 3 have yet to be announced in North America, though filings dating back as far as May show that Tesla's Fremont plant may already be preparing to produce the newly designed vehicle, so this could come sooner than a lot of us expect. And right now we're expecting the beginning of 2024, give or take, maybe December, maybe January, in that time frame. The sooner the better Tesla can get these refreshed Model 3s out to the US, the better. Because let's face it, from now until the end of the year, you're probably going to see increased orders for Teslas, just simply based on the fact if you're a business owner or you are self-employed and you pay taxes, it's very much incentivized that you buy a Tesla if you want to take that $7,500 IRA tax credit in this year. If not, then you'll do it in 2024, and you'll have the option to sell that tax credit to the dealership and basically get a $7,500 off invoice to your purchase. So in other words, this year, if you pay taxes, you are highly incentivized to buy a Tesla by the end of this year. For everyone else, for normal Americans out there that might not pay taxes, you're more incentivized to buy a Tesla next year. So I do think you will see a flood of demand for Teslas from now until the end of the year, as we are seeing with the Google Trends data. Tesla in Google Trends is obviously seeing a nice, healthy uptrend in search data, but also the Model 3, the Model X, the Model S, and the Model Y are all seeing a very similar spike, as you have also seen with just the search term of Tesla. In August of 2023, so last month, Tesla was at 66, the Model 3 was at 7, the Model X was at 2, the Model S was at 3, and the Model Y was at 6. Today, the Model Y is at 7, the Model S is at 4, the Model X is at 5, the Model 3 is at 13, and Tesla in general is at 75. If we go ahead and pull this out to the last maybe 5 years is the best way to maybe look at this. You're seeing a spike basically across the board. And let's take Tesla off here to just look at the vehicles themselves. And that's the best way to look at it. Look at the spike on everything. Everything is spiking with Tesla. A lot of it has to do with the $7,500 tax credit. That if you want to take advantage of that, you have to do that by the end of this year. Also, the refreshed Model 3 going live. It seems like you've gotten a benefit to all the models from Tesla just because they released the new Model 3. Likely going to be the same thing, but on a bigger scale with the Cybertruck. Everyone's going to be talking about the Cybertruck. Roland Percher is reporting that Slovenia reported 155 Tesla sales and 4.4% market share for August. Look at these numbers, guys. Just from 2020 until today. This is over a 300% increase for Tesla sales in Slovenia in just, from last year. And this follows a similar trend of other markets. Italy, the UK, even Germany. They're seeing similar kind of growth rates from Tesla. Not all of them, all of those countries are at 300%, but a vast majority of them are seeing 60, 70, 80 plus rates of growth year over year. Guess what is trending on X? Hashtag Elon Musk is a traitor with almost 21,000 posts because presumably he obviously shut off Starlink within 100 miles of the coast of Crimea because Russian leaders said they would use nuclear strikes if their naval fleet based in Crimea was attacked. And basically Elon kind of hinted that it would be a problem, right? That they were planning this assault on the Russian fleet. Russia said they would respond with nuclear weapons. So, sorry, Elon was trying to avoid a nuclear fallout scenario. Again, I don't highlight this to be political. Have your opinions. That's what's great about this country or the world. But it's not going to affect Tesla's stock. Not in the slightest bit. Now let's switch gears and talk about how CPI could be important, what my estimates are, and what banks from Wall Street's estimates are. Now, on a completely separate note, take a look at what this analyst just had to say today about Tesla stock. It's quite fascinating, the picture they are painting.
Shares of Tesla giving some back today after a big boost yesterday on a very bullish note from Morgan Stanley's Adam Jonas. RBC also staying positive, writing in a note today that Tesla should be able to capitalize on IRA tax credits more than any other automaker. Shares are down nearly 2% this afternoon. But Needham says not so fast. They're seeing some profit margin pressures ahead and say fully self-driving cars are still a ways off. The firm lowered their 2025 Tesla earnings estimates to 15% below consensus. And joining me now, the analyst behind the note, Chris Pierce. He covers EV names at Needham. Chris, welcome to the program.
Thanks for having me.
Would you describe yourself, just to set the scene here, as a Tesla bear, or is this more of a tactical call?
I would say more tactical than not. I do think Tesla deserves a premium multiple. I think Tesla is going to sell a lot of EVs in the next few years and beyond, but I just struggle to, given the price cuts we're seeing, the price cuts in FSD for the first time, I just looked at consensus estimates for margin improvement in 24 and, looking at raw material inputs, looking at the potential for future price cuts, looking at legacy mass market operating margins, I just struggle to see those Tesla being able to meet those expectations.
Yeah, I mean, I look at what's coming out of China, and I would be really worried if they do to EVs what they did to other consumer products. There could be a lot more downside ahead, couldn't there?
Yeah, I think we're already seeing that at the high end. I mean, Tesla's cut prices for the Model S and Model X, by a decent amount this year. I did some channel checks at local Mercedes-Benz dealerships. I live in Northern California. We're already seeing, at the high end, Mercedes dealerships in Northern California, over 50% of their deliveries this summer have been EVs. And we're seeing similar stats in similar direction in Southern California. So, what's going to happen as we see competition at the mid and lower end? We're going to see Tesla potentially have to take further price cuts to stay competitive and to keep these factories humming and get cars on the road. So I just struggle to see margins moving back at the pace that consensus expects them to, especially next year.
Yeah, the headline of your note is lower for longer, which all of our viewers will appreciate, is a little bit of a nod to what we've been saying opposite about the Fed. So I don't know if you gave Adam's note a read yesterday on Dojo. Just kind of put that in context. As you say, they just cut the price of full self-driving. So, how big a market and an opportunity do you think they really have?
I didn't read the note. I think we're actually making similar calls. He's saying not to put words in his mouth, but he's saying there is this out year goodness around what can happen if they put all these pieces together. We don't have a lot of proof points that they can put those pieces together. That feeds into why they would cut the price of full self-driving. They need to get more vehicles on the road with this package so they can do more video learning to kind of as a strategy shift from a code-based program to kind of a video capture program. So they need to cut the price of full self-driving to get more cars on the road to gather more data. But he's saying this goodness might not be recognized in the stock in the longer term. I'm saying this bumpiness in the short term is not being recognized in the stock versus, what might happen if you look at consensus estimates. So, he's just taking a longer term view and saying people aren't focusing on X. That may happen, but on the road to X, people aren't focusing on Y. I should have reversed those letters since Y comes before X in the alphabet, but the road to get there is going to be choppier than I think most people expect.
Is it V? What comes before X? Okay.
I should have just said A.
They're telling me I gotta go. Chris, thank you very much for joining us today. It's a great note. I encourage everyone to read it. We appreciate your time, Chris Pierce.
Let's first look at the estimates from Wall Street as a whole. So on your core inflation month over month, which I personally think is the most important, you're expecting 0.2%. Last month's reading was 0.2%. This is 2.4% annualized. This is really the reading in which you could say, okay, maybe some of the headline increase is just headline increase noise. It doesn't matter. Inflation is still coming down. If your month over month core increases, we're going to have a problem. So I'm going to tell you that right off the bat. You're expecting 0.2%. Anything higher than 0.2%, not great. 0.3%, not good. And that sets us up for another rate hike. And what the markets are pricing in, well, would not be great. And we'll look at that here in just a second. And I do think it's important to know that we only get the 0.2% or 0.3% headline kind of number, but it actually does work on a decimal point as well. So if this comes in at 0.25%, then they're going to round up to 0.3%. If it comes in at, 0.15%, they're going to round to 2%. If it comes in less than that, they're going to round to 0.1%. So odds are it does come in at 0.2%, but there is a chance that it comes in higher than that, and that would be a problem. The core year over year, that is expected to fall quite a bit from 4.7% last month to 4.3%. That would be great news as well. I don't think the year over year matters nearly as much as the month over month as far as getting another rate hike or seeing the Fed actually pause. It's your month over month that matters the most. Now, your headline month over month is expected at 0.6%. That is almost 7% annualized inflation. If you times 0.6 by 12, almost 7%. That would not be great. Now, last month was 0.2%. So you're expecting a big increase, mostly due to energy. Now, energy does fuel into the rest of the economy. Anything that you are drinking right now, like this Evian water made by the French Alps, all natural spring water, or this Frank's Red Hot, or, your phone, or anything else for that matter. It's transported, right? So everything touches through oil. That's the question. Does the increase in energy cost get passed on to consumers or not? I personally don't think so, but it's a possibility. Your headline inflation rate is expected to come in at 3.6%. Last month's reading was 3.2%. So the big number you really want to watch is your core month over month. If that comes in at 0.3%, you're going to have a big problem. If it comes in higher than 0.3%, which I think it's very unlikely it will, at like a 0.4%, then you have a colossal problem, and you probably see a 3 to 4% drop in the markets tomorrow. That would be my estimate. Nick Timiraos, kind of seen as the Fed's mouthpiece, did post this, and it's the big banks, the top banks' estimates for inflation tomorrow. I don't see Wells Fargo on there, but most of your big banks' expectations for inflation. Now, basically all of them are in line with the 0.6% headline CPI. Some of them, like UBS, Citi, and Barclays, expect headline CPI could come in at 3.7%. The other guys, Goldman Sachs, JP Morgan, Morgan Stanley, Piper Sandler, TD Securities, Bank of America, they all expect 3.6%. What is interesting here is core CPI month over month. So Citigroup expects 0.25%. This would get rounded to 0.3%. So I want to highlight, it's not priced into the markets to get anything above 0.2%. Piper Sandler is as low as 0.14%. That would come in at 0.1% because it would get rounded down, right, to 0.1%. So that would be a really good scenario. But most of your major banks are basically saying CPI is going to come in at 0.2%. It's not going to get rounded to 0.3%. Besides Citi, which I do find interesting. And I think it makes it, like I said, a lot more potentially volatile and a lot bigger downside if it does come in at 0.3% or 0.25% and gets rounded to 0.3%. So keep that in mind. Now, core CPI is all the estimates are 4.3% year over year. So I think core CPI personally is going to come in at 4.3%. I do think there's probably a 30% chance month over month core CPI comes in at 0.3%. More like 0.25%, but gets rounded to 0.3%. Nobody cares about the rounding. People care about that just what the number is. Now, I think there's probably a 50% chance that you come in at 0.2%. And I think there's probably a 20% chance you come in at 0.1%. So I do think there's a greater chance that you come in at 0.3% rather than 0.1% based solely on the rounding that would happen. Like, just so everyone knows, for an example, if Barclays is right on and Bank of America is right on their estimate at 0.22%, well, core CPI month over month is going to read at 0.2%. If Citigroup is correct and core CPI month over month comes in at 0.25%, just a 0.3 difference, well, it's going to read 0.3%. So I'm not actually expecting inflation to be 0.3% or higher than that, but I'm expecting maybe in the high 0.2, 0.25, 0.26. That would get rounded to 0.3, and that would be a problem. But odds are 50%, I would say. Odds you come in at 0.2%. So this should be one of those events where people are kind of fearful like we've seen today, and then stocks might actually do well tomorrow. The data coming out tomorrow with retail sales, I've highlighted this probably too many times here on the channel, that's going to be more important because retail sales give you the estimates for GDP. So last month, for the first month of Q3, we had a 0.7% month-over-month retail sales number. Just because I'm going to do the math on the calculator, that would be 8.4% annualized retail sales. That's far from a recession. So the average analyst has their GDP estimates for Q3 at 2.4%. Well, hey, if retail sales come in at 0.2% as we're expecting on Thursday, that's not great. That's not gonna be good for GDP estimates for Q3. Your Q3 GDP report comes out October 26th. So we do have some time. And I think your estimates for GDP, whether they go really up or down, I think they can move the markets quite a bit. And I don't think GDP estimates are going to go up from here. I think they're already too high. Odds are they probably come down, and that's how you could get short-term kind of weakness in the markets if those GDP estimates do come down. Now, if retail sales were to be really bad and maybe really negative, maybe a 0.5% negative, 1-2% negative, then that's more of like a potential black swan event. A big kind of decline in the markets, as markets have not priced in a recession, and they might be forced to start pricing in a recession. Now, as we can see from this chart from Carson Investment Research, typically this week of the markets tend to be pretty good for September until quad witching. And then after quad witching, when trillions of dollars of option money essentially gets unlocked, right? Because if you're in a position with options and you have $1 trillion, call it, well, you're not moving that $1 trillion around actively if you're in that position still. But after you're quad witching and you can move your money around, it seems like historically in the month of September, you tend to get a lot of downside positioning, a lot of profit taking after quad witching. So historically speaking, this week should end bullish, but it's the following last 2 weeks of September that tend to be a little bit more painful. But unfortunately, this chart or picture, whatever you want to call it, really does not account for seasonality of CPI. Oh, wow. That was rough. Let's try that again. CPI, PPI, retail sales, or any of the other data that we have for this week. So historically, this week tends to be bullish for the markets, but not every year do you have CPI, PPI, and retail sales in the same week of September. So keep that in mind. You can only use this as a gauge so much. It's possible tomorrow could be really negative if CPI is bad. It could be really positive. My expectations, well, 50%. We're come in line with expectations. You might see a sell-off in the markets just because of seasonality, but it wouldn't be a terrible event. There's probably a 30% chance we get rounded up to 0.3% month-over-month core, and that's a big problem for the markets. That would be a problem for credit-specific companies like a Tesla, because that will mean maybe the Fed will end up raising rates, possibly a couple of times as far as what the markets are pricing in. And there's like a 20% chance we come in at 0.1%, which would be the best case scenario, and I would probably expect a 1.5 to 2% rally across the board. Now, why this CPI report in particular is so important, because this could be one of the big kind of differences on whether we get multiple rate hikes or no more rate hikes. So for September 20th, that is just 8 days away, 7 days away coming tomorrow, you're going to get the next Fed meeting. Now, this data will really determine what the Fed is going to do. There's a 92% chance the Fed pauses. There's an 8% chance the Fed raises rates. If you come in at 0.3% month-over-month core, the odds of a Fed rate hike are going to move up quite a bit tomorrow. Now, I don't think September is really what you need to be watching. And you guys can watch this for yourselves. Investing.com/Fed rate monitor tool, or just Google Fed rate monitor tool. And this will give you the probabilities. Historically, the Fed has always done what the markets price in over 50%. So whatever's in blue is historically what the markets do, or what the Fed does, because the Fed does not want to upset the market expectations, right? They don't want to de-anchor the market's expectations. It's for November and December where things get really weird. So for November, there's a 58.7% chance the Fed continues to pause, that we don't get another rate hike at all. There's a 34.8% chance we get one rate hike, which would be in November. And there is a 2.9% chance we get two rate hikes by November. So that would be a rate hike in September and a rate hike in November. So if inflation comes in high tomorrow, higher than expectations, this probability for two rate hikes, depending on how the probability for September moves, will probably move up somewhere around 15 to 20%. And a lot of your trading algorithms are based on these Fed futures for interest rates. As the probability for interest rate hikes goes higher, in which it has for November and December over the past 2 weeks or so, what's happened to the markets in that same span of time? Well, the markets have rolled over a decent amount. You're still pretty close to all-time highs in the grand scope of things, but you have rolled over quite a bit just in the past couple of weeks. Now for December, this is very strange. So there is a 0.2% chance, which has actually went up from the last time I looked at this. It was at 0.1%. Now it's at 0.2% chance that we get 4 rate hikes by September. Well, technically 3 rate hikes by September. That would be a hike in September, a hike in November, and a hike in December. This would bring the Fed funds rate in between 6 and 6.25%. There is a 5.1% chance we get 2 rate hikes by December. So that would be maybe a skip in September, rate hike November, rate hike in December. But there's still a 55.1% chance we do not get another rate hike heading into December. So these probabilities are going to move around a lot tomorrow, and you really want to watch this, because if the markets are, reacting a certain way, it's probably because these future expectations for rate hikes either went up a lot and we're now expecting more, or potentially went down and now we're expecting less rate hikes. This is something you really want to be watching tomorrow if you are an active trader, investor, or you're just maybe hedging out your portfolio right now. And that's a good segue to introduce the programs down below. If you guys want to come trade with us live in real time, I put out all of my trades every time I make a trade, and provide a thesis and any specific news that comes out, or any reason we're making the trade is provided. Really, it's a good way to maybe hedge out your portfolio during bad times and reinvest that money back during maybe a time where you'd want to buy as many shares as possible. So if the markets fall, you can hedge out your portfolios, you can make a lot of money, you can properly hedge, and then take that money and put it back into a Tesla at a much lower price. That is hopefully something that helps you out with. So if you guys want to come join, link down below in the description of this video, or just come support the channel as well, that is always welcomed. So in particular, why this could be so important for Tesla, the CPI report tomorrow, if you start to get the markets pricing in 1, 2, 3 more rate hikes by the end of this year, getting Fed funds rates up to 6%, you not only increase the odds of a recession, and likely a deep one at that point, you put immediate pressure on lending, because these probabilities move around the bonds. So bond yields would likely rocket higher tomorrow if your CPI report comes in high. And that instantly puts pressure on lending, in which Tesla's business model really revolves around lending. About 90% of new vehicles are bought with a loan. So that would not be great for Tesla's business. I do think Tesla has a lot of positive things that are happening right now, a lot of positive catalysts we talk about all of the time. So I think Tesla's in a little bit better maybe of a position than a Ford, GM, legacy automaker, credit card company, or the banks, or other sectors of the markets that are affected by more rate hikes from the Fed, but it would still not be great. And depending on the potential CPI report, well, if it comes in really high, if it comes in at 0.3 or 0.4% month over month for the core, Tesla stock could easily tomorrow fall to 250, 240, just depending on the degree of the inflation report and the market's reaction following that. Now, odds are, like I said, you're probably going to get a muted or even bullish reaction if CPI comes in line with expectations, and that could actually move Tesla stock up as the markets do not price in any additional rate hikes or assign greater probabilities for additional rate hikes. So if I were to put my money on it, up or down 2-3% is what I would say. Then you get into, again, like a 30% chance you fall 5% on Tesla stock if core comes in at 0.3%, and there's probably a 20% chance that Tesla stock could go up 5+% tomorrow if core month over month comes in at 0.1%. Your core is really what you want to be watching right now. So that is going to do it for this video. Hit that like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. Let me know what you think about CPI and Tesla stock in the markets coming tomorrow. Are we due for a larger pullback? Are we going to rally from here? There's honestly a good case for both sides. So let me know what you think down below in the comments section. Hit the like button, like I said, subscribe to the channel, all of that good stuff. My name is Michael Tyler. Enjoy the rest of your day, and I will see you in the next one.